Hey traders! In today's video, we're diving into a super effective order block strategy with a high win rate. If you're looking to boost your trading results, this strategy could be the key. We'll guide you through each step, from candlestick patterns to the rules that make this strategy work. If you're ready to level up, hit that like button, and don't forget to subscribe for more tips and strategies. Now, before we dive into the details, here's a quick rundown of what we'll be covering today, so you know exactly what to expect. We're going to break down the powerful order block strategy step by step, from understanding what a steady base order block is, to identifying the key candlestick patterns and rules you need to know for high probability trades. You'll also learn how to spot golden order blocks that give you an extra edge, plus tips on the best time frames and pro techniques to manage risk and maximize profits. So, stay tuned, because by the end of this video, you'll be equipped with everything you need to take your trading to the next level. What is the steady base order block? A steady base order block is an area of accumulation in the market where the price temporarily pauses after a move before continuing strongly in the same direction. A bullish steady base order block forms when the market is trending upward. The price rises, enters a period of accumulation or consolidation, and then resumes its upward movement with strong momentum. This strong move is known as displacement, and it signals the participation of smart money. This area is considered a smart money entry point. When the market retraces back to retest this zone, there is a high probability that the price will move upward again. This is the core concept behind the strategy. Identify this area, wait for the market to retrace, and then enter alongside big institutions to capitalize on the next probable move. A bearish steady base order block occurs when the market is trending downward. The price drops, enters a phase of accumulation or consolidation, and then continues its downward movement with strong momentum. This sharp move is known as displacement, indicating smart money involvement. Similar to the bullish scenario, this area is regarded as a smart money entry point. When the market retraces back to retest the zone, there's a high probability that the price will continue moving downward. The strategy here is simple. Identify the steady base order block, wait for the market to pull back, and enter in line with institutional traders to take advantage of the next likely move. In simpler terms, a steady base order block is a supply or demand zone that forms as an accumulation or consolidation during a trending market. These zones act as key points where large players position themselves before driving the market in the same direction, either pushing prices higher in an uptrend or lower in a downtrend. However, in choppy or sideways markets where trends aren't clear, we can't consider these formations as steady base order blocks, even if valid candlestick patterns appear. But if the price begins to form a clear trend afterward and meets the right candlestick criteria, we can then identify it as a steady base order block. Now let's see how to identify steady base order blocks using candlesticks. To identify a valid steady base order block from a candlestick perspective, you need to follow specific rules and criteria. The price must experience a temporary pause within a sequence of at least 4 candles. Each candle in this sequence should not close above or below the previous candle's range. In a bullish scenario with a clear uptrend, suppose we have a 4-candle sequence where the second candle doesn't close above the first. The third candle doesn't close below the second. The fourth candle doesn't close above the third. Please note that within a candle series, the third candle may close above or below the previous candle's range, or the fourth candle may close above or below the range of the second candle. However, this can still result in a valid steady base order block. Now that you know how to identify this setup, how do you draw the steady base order block zone? To mark the steady base order block, draw a zone that overlaps the majority of the accumulation candles, including both the wicks and bodies. Ideally, this zone should cover at least 2 candles entirely. This same approach applies to bearish scenarios as well. If you've watched my previous videos, you'll know that for an order block to be valid, it usually needs to break the previous structure. However, with this order block trading method, there's no need to wait for a break of structure to validate a steady base order block. Once the price closes above the highest point of the candles within the accumulation area during an uptrend, or below the lowest point of the candles within the accumulation area during a downtrend, the steady base order block is formed and ready for trading. Alright. Now let me show you some real chart examples to help you understand how to identify and trade the steady base order block. As you can see here, the market is trending upward before pausing in a 4-candle sequence. The first condition is met, the market is in an uptrend. The second condition is the 4-candle sequence, which is the minimum required to consider the pause as an accumulation. Now, let's analyze the candles to see if they meet the criteria for a valid steady base order block. As you can see, the second candle doesn't close below the first candle's range. The third candle doesn't close above or below the second candle's range. The fourth candle doesn't close below or above the third candle's range. So this is a valid steady base order block. Let's now draw the zone. Alright, we have a valid steady base order block. Now you have two entry options, and there's no right or wrong choice. It all depends on your personality and risk tolerance. The first entry option involves placing a buy limit order at the highest point of the order block. You'll set your stop loss a few pips below the order block and aim for a 1 to 2 risk to reward ratio. The price pulls back, activates the order, and then moves upward to hit the take profit. This strategy isn't a holy grail. Sometimes the market will hit your stop loss, take you out of the trade, and then move in your target direction. Other times it will activate your limit order and reverse, hitting your stop loss. If this happens to you, you're not alone. We've all been there. What matters is sticking to the strategy because, in the long run, it's profitable. Now, the second entry option is to wait for a candlestick signal when the market pulls back to the steady base order block zone. As you can see here, we have a clear pin bar signal. This rejection shows that smart money is present, and they're likely to drive the market upward. You would place your entry at the close of the pin bar, set your stop loss 10 pips below the steady base order block zone, and aim for a target that's twice the risk taken. This strategy is more conservative and can protect you from some losing trades. However, sometimes the market will hit the steady base order block zone and move strongly upward without giving you time to enter. If this happens, don't get frustrated or feel like you missed the trade. It's just part of the game. Accept the market as it is, and go find another trading opportunity. Let's look at another chart example, this time in a bearish scenario. The market is in a clear downtrend before pausing in a steady base order block. Following the same steps, you identify the order block by spotting the 4-candle sequence where the price consolidates. None of the candles close outside the range of their immediate neighbors, confirming the setup. Once the price pulls back to the steady base order block, you have two entry options. First option: place a sell limit order at the lowest point of the order block. Set your stop loss a few pips above the order block and aim for a 1 to 2 risk to reward ratio. The market pulls back, activates the order, and then moves downward, eventually hitting the take profit target. Second option: wait for a candlestick confirmation signal, such as a bearish engulfing pattern or a pin bar rejection, when the market revisits the order block zone. After seeing the signal, place your sell order at the close of the candle, set your stop loss 10 pips above the steady base order block zone, and target twice the risk taken. As you can see, the trade plays out successfully and hits the take profit target. Now that you understand how to identify and trade steady base order blocks, let's talk about the best time frames to maximize your results. When it comes to trading steady base order blocks, higher time frames such as the 1 hour, 4 hour, and daily charts are ideal. These time frames provide a clearer view of market structure and key levels, helping you identify more reliable setups. The larger the time frame, the more significant the order block, and the stronger the price reaction when the market retests that zone. The great thing about trading on these higher time frames is that there's no need to perform top-down analysis. You can analyze and execute your trades on the same time frame. Let's dive into real examples on each time frame. On the daily chart, the market is in an overall downtrend but takes a breather, forming a steady base order block after a bearish move. We observe a 4-candle sequence where the price consolidates without breaking the highs or lows of the previous candles. Following this, the market moves downwards in what's known as displacement, a clear sign of market maker participation. When the market retraces back to retest the steady base order block, you can place a sell limit order at the bottom of the steady base order block, expecting the price to revisit this area before resuming its upward trend. You set the stop loss a few pips above the order block, and since we are trading on a higher time frame, aim for a 1 to 3 risk to reward ratio, targeting a lower swing point or the next major support level. As expected, the price pulls back to the order block, finds resistance, and continues the downward, eventually hitting your take profit target. The larger the time frame, the more significant the reaction, and in this case, the daily chart provides a high probability trade setup that plays out over several days or weeks. Now let's look at an example on the daily chart. Remember, you can use this strategy on both the 4 hours and hourly time frames. The market is in a clear uptrend. After a significant move higher, the price pauses, forming a steady base order block, signaling that smart money is likely accumulating buy positions. On the daily chart, we spot a steady base order block made up of 4 candles, where none of the candles break the range of their neighbors. This shows that smart money is preparing to continue pushing the market higher. Once the market retraces back to retest the steady base order block, you place a buy limit order at the highest point of the steady base order block, expecting the price to pull back and retest the area before continuing upward. You set the stop loss a few pips below the order block to protect against a potential reversal, and you aim for a 1 to 3 risk to reward ratio, setting the take profit target at the nearest swing high or a key resistance level. Once the price retests the order block, it respects the zone and moves sharply upward, hitting your take profit. And that's a wrap for today's video. If you got value from this, make sure to smash that like button, subscribe, and hit the notification bell so you don't miss any future content. Thanks for watching, and I'll catch you in the next one.